And Peter, welcome to F.A.C.E. I'm going to make you a panelist. I'm not sure if you brought anything to show, charts or anything, but I'm going to be showing your website right now, so waiting to hear your voice. And if you need the screen, I could pass it to you. Nice to meet you, Peter. Oh, hold on.
Dale, I don't think you've added.
I am muted.
I can see that.
Yeah, hi, Peter. How are you?
Can you hear me?
Yeah, Peter, I could hear you. Can you hear me?
I can hear you fine. Great.
All right, so very nice to meet you, Peter. Thank you for taking time out of what will probably be another wild market day, but you're a macro guy anyway. I wanted to introduce you to our community by showing your website, Financial Insights with a Y. And you can see that Peter is, his work has been published everywhere. He's also he's an author. He wrote Moods and Markets. He's been on CNBC, Reuters, Financial Times, and even the right-wing Fox Business Report put you on. So that's great. And you're an adjunct professor at Lerner College. It's in Delaware. And you've done several TED Talks. So, gosh, Peter, great to have a guy with your background with finally a little bit of fear coming into the street late last week. So, how you doing today?
I'm doing great, and this is really, you're right, this is a really exciting time to be talking about fear and confidence in the markets, because I think we're at a critical inflection point, and one that's been obviously long in coming.
Okay, so I've talked about your accomplishments. What always interests me, and I'd like to start there, Peter, is did you have an economics background in college? How did you end up being where you are now? What was the beginning of your journey like?
So I think of myself as having two careers. I spent the first part of my career on Wall Street working for JP Morgan, building their asset-backed securities business, and then working for one of my clients, First USA, a credit card issuer that got bought by Bank One, and then ran a variety of functions for that organization. And decided when I turned 45 and my then 6-year-old son told me that I was halfway to 90 to do something else. And it just happened to coincide with the financial crisis, and my background was ideal for helping a group of money managers and hedge funds navigate the crisis.
Okay, so wisdom from babes. We should always listen to our children. Plus, you probably were hardly around. You were so busy, and you found a way to spend more time with your family and still, keep your hand in the economy and the financial markets.
And it gave me the luxury, honestly, of trying to better understand why markets behave the way they do. And I stumbled across some work that Bob Prechter had done, and I think most of your followers will know Bob from his work with Elliott Wave.
Right.
But he's done some really interesting work in something called socionomics, which looks at the impact of mood on decision making.
And things like the kind of movies the public's watching, and fashion, and all of that. So with all this euphoria that we've had in financial assets, and last week may have been a crack, bond markets potentially in a bigger bear market than equities. What do you diagnose social mood as right now, especially with you can't even talk politics on Thanksgiving with your family anymore, or they won't talk to you for a month. So what is the social mood in the USA right now?
So I think I think there are two very distinct moods. Those who are closest to financial assets and technology are euphoric.
Mm-hmm.
You know, the euphoria that you see measured by the Dow and the S&P is mirrored behaviorally in what I see, whether it's talking to people on Wall Street or talking to people in Silicon Valley. And where finance and technology come together, aka cryptocurrencies, the euphoria is, you know, cubed, quadrupled by that simultaneous combustion. And the cryptocurrencies are really important to me because it looks like that euphoria has exhausted itself. And one of the things that I observe over and over in history is that manias mark major market tops. Think about Beatlemania in the early 1960s. Perfect coincidental behavioral parallel in music with what we're seeing in the cryptocurrencies.
Interesting.
And the other thing I've noticed is the most outrageous, outlandish, craziest risk-taking arrives last at the party. If you go back to the mortgage peak, you had this onslaught of subprime mortgage lending. You know, we were going to lend money to people who had no jobs, no income, to speculators.
Well, let me interrupt you. That's one of my shortcomings in an interview. You talk about real estate and the euphoria before the financial crisis. Isn't there as much euphoria now with real estate prices in the hot markets on the coastlines, even being worth more than they were at the peak in 07, 08? Every financial asset class of the wealthy has appreciated, and there's wild prices being paid for real estate, not just here. Toronto had a crazy bull market in real estate. Do you think that that it may not be a mortgage crisis, but that we could see that asset class, the air come out of real estate again as well?
Yes, particularly luxury real estate. You know, if you think about what's happened in New York and all of those pencil-thin skyscrapers, you know, what's affectionately referred to as Billionaire's Row. Right. That to me is just a perfect embodiment of the euphoria that we've seen in luxury real estate that, to your point, has not only rebounded from the crisis, but has gone on to mirror the Dow and the S&P and its valuation.
I thought we'd have an echo bubble in real estate because of easy money, but I never thought that we would surpass the 2008 values like we have. And you know what, Peter, what do you think about, you brought up Billionaire's Row, and there's big protests by one of the buildings, I think the most expensive building. Any socioeconomic hints or market tells with them putting a homeless shelter on Billionaire Row right next to one of the buildings?
Yeah, I mean, I think that's indicative of the real underlying social mood that exists on Main Street. You know, I think we have a huge confidence divide that most of America.
Let them eat cake. Let them eat cake, right, Peter? I mean, it's almost like that book, isn't it? It's the best of times and the worst of times.
Mm-hmm. Yeah, it's very Dickensian.
Yeah, so how does it resolve itself? And I did go and look at a few headlines on your website, and what interests me is one of your titles was, "Don't count on Donald Trump and Wall Street's love affair to last," because he's been, you have to admit, I mean, we rallied 30–40% since the election, and he talks about it all the time. What's going to be the catalyst for that love affair to end? A bear market?
Yes, and what you're seeing is, and to me, this is such an indicator of things to come, and you saw it last night at the Super Bowl. So you have this entrenched, extremely confident incumbent that is surprisingly upended by a group of underestimated, less
Journeyman.
appreciated outsiders.
Yeah, love it.
And you've seen that with the rise of the Me Too movement and the rebellion that you're seeing with women against extremely powerful elite men, whether it's in Washington and in Wall Street, in Hollywood, in sports.
And it's effective for the first time. They're taking them down. So,
yes.
So there may have been these kinds of, well, even back to the election, there were accusations against Trump, and it didn't take him down. But now it's taking people down, powerful people down that maybe 4 years ago, it wouldn't have had the same impact. So you're seeing this as a sign of the change that a guy like Nick Foles, who was going to retire hang up his cleats a few years ago, ends up guiding the Eagles to a Super Bowl, and all these lawsuits taking down people like Harvey Weinstein and congressmen and senators.
Exactly. The outsiders come in bear markets.
Interesting. Okay. All right. So what do you think is going to be the pin that pops this bubble? Is it just gravity? Could it be a misstep by the Fed? I've talked to people about the fact that the Fed began to tighten, I believe it was in 37, while we were starting to recover. And then we had another bear market until World War II, while the Fed made the mistake of tightening. Exactly what's happening now? Is that going to be the catalyst?
I think the Fed is contributing, but I think that the other piece of it is investors' own extrapolations of what the Fed is going to do ahead. I mean, if you look at the certainty that investors have that there are going to be 3 or 4 rate hikes this year, they're doing the Fed's dirty work for them. And that extrapolation, I think, is what you're seeing flowing through the bond market. And that's the real issue, is that investors have taken the bond market one place and folks are just waking up to its impact on the stock market.
I see. Okay, so the bond vigilantes are back in force. I've noticed that there could be very long periods of disintermediation between bear markets and bonds, and the equities finally reaching a tipping point to, like, for example, in 87, yields were going up, the dollar was going down, but before the crash, the market kept going up. So actually, didn't yields have really, they bottomed 2 years ago. So this has been already a fairly long period of rates not going lower and just edging up and not being able to make new yield lows for a few years. Do you think disintermediation can happen for a bit longer, or we're at that tipping point now?
Well, what's interesting to me is, and I tweeted this chart over the weekend.
You want to show it? I could hand you off the screen share if you wanted to show it. But.
No, that's all right. I can explain it quite simply.
Okay.
If you go back to the end of 2013, the market, the equity market, moved as interest rates were moving up in the 10-year. And actually, the 10-year reached 3%, with stocks moving lockstep up with it. And what is so interesting to me is rates were higher and nobody was apoplectic. Yes, we had the taper tantrum, but that was a bond market issue. Now we have rates actually lower than they were 3 years ago, and people are really, really freaking out about it. And that's a really important distinction. Lower peak in bonds, but much, much angrier sentiment.
Okay, so even though we're at lower levels, the impact is starting. So we're at 3%. It's going to be worse at 3% now than it was in 2013. And was that the peak in rates in 13?
Yes.
Okay.
Just a little over 3%.
All right. So we also have to talk about a lot of optimism about the new tax plan that was passed. What type of socioeconomic tell or market tell do you get from that happening at this time?
So the first thing I would say is that the passage of that itself is a statement of extreme positive mood. That Congress was actually able to come together and, approve and pass some kind of tax legislation is really significant.
Well, they didn't come together, but they passed it.
They passed it. It was
like Obamacare. Obamacare was all Democratic votes, and the tax plan was all Republican votes.
But there was finally a success.
Okay, a success. All right.
And what you've seen is markets top on good news, not bad. And to me, this is an indication, particularly for the financial markets, of really great news. And what you've seen is this huge present valuing. Again, markets, investors extrapolating the benefits of these lower rates, as far out as the eye can see, and turning that into higher earnings forecasts and higher multiples simultaneously. And that's exactly what you would expect at a major peak in mood, that investors are saying the future is so bright, I'm going to need shades, and I'm going to, in turn, boost my forecast. You were having, CNBC described it as this leapfrog effect, where analyst after analyst were raising their estimates, and at the same time, folks translating that into higher multiples. So I just think that you've seen this enormous present valuing of a very certain future that is almost certain to disappoint people.
Okay, so why don't we move? Okay, why don't we move to our bailiwick, which is currency?
Mm-hmm.
And the dollar's been in a bear market for, I don't know, about 14 months. I know it wasn't because Donald Trump asked for a lower dollar a year ago, our president, but recently there's been, we've heard both sides of from Mnuchin. He said a weak dollar is good, we can export, and then the president came out and said we want a strong dollar. Does the dollar in any way play into some of this, the jigsaw puzzle that you're putting together for people?
Yes, because I think that you've got linking an enormous interconnectivity between equities, bonds, oil, and the dollar. And I think that the danger in all four of those markets is that people find themselves suddenly off sides. And the scenario that I envision, given the webbing that exists there and the positioning that I see, is that you have equities decline, bond yields decline, oil prices decline, and the euro decline.
Okay, so we could be approaching an inflection point for the resumption of the uptrend of the dollar after it's been going down. A weak dollar has been supportive for multinationals, et cetera, and a strong dollar is going to be a tailwind for commodities like oil and possibly gold, although I've seen them both go up and down together. Is that your forecast, that a strong dollar could also be another pin that pops a bubble that has been aiding and abetting this euphoria?
Yes, because to your point, analysts have been presuming not only a weak dollar, but a continually declining dollar in those future earnings forecasts. So that too is going to put pressure on forward earnings that is going to come as a surprise.
Okay, so Peter, you advise people and you put out your views with your research. What are you telling people to do? Just buy 90-day T-bills and roll them and have a lot of cash? No one liked cash has been trash for 8 years now. Is that the advice? More about, instead of the return on equity, the return of equity?
Absolutely, and I think there are some places where there are fabulous opportunities to be long. I think that the repression that we've seen in volatility is a natural place to now be long.
Okay.
The short vol trade is extremely crowded, and I think that you could see the rubber bands, snap back particularly sharply there.
Okay.
I like to look at trades that people laugh and giggle at me, or think I'm a moron for suggesting them. And being long volatility has been one of those.
Like we're kindred spirits, but if you, especially if you were saying this for the past couple of years, then you're the boy who cried wolf, and no one believes it. You're, a lot of the bears, you don't even hear about them anymore.
Exactly.
And, okay, so and I interview very smart people who are, bearish, like Peter Bookvar, and a lot of people that were amazed. I was amazed by the magnitude of this move in equities. Were you a lonely guy for a while?
Oh yeah, I have a great deal of respect now for all those Old Testament prophets.
That is a pearl, Peter. All right, so vol looks good. A lot of people, would you consider yourself a deflationist then in this environment? I mean, we're finally getting the Fed targets of where they wanted inflation to be. And what you're describing sounds pretty deflationary to me.
Yeah, and I think you're seeing that already in places like retail. The things that we want are deflating far faster than the things we need. But I think that, whether it's going to be rental prices, energy prices, healthcare prices, I think that those three are particularly vulnerable to deflation, and certainly nobody is thinking that is even a possibility today.
That is really, that's a bold call, and it's interesting you bring that up. There's talk in California about there was a law about rent control, and they want to expand rent control because people can't even work in the Bay Area. They have to commute for 4 hours because they can't afford housing, and they want to expand that rent control. That could happen everywhere because the middle class is squeezed by rents, housing costs, the three that you mentioned. That's why, when the Fed says there's no inflation, people go, what do you mean there's no inflation? Everything I buy, my food, my housing, my health care, has doubled or tripled. So you think there's going to be relief, but with that relief comes a fairly poor economy, doesn't it?
Yes, sadly.
Yeah, okay. So Peter, a really interesting, contrarian type of take. It was great talking to someone to get the other side of the coin. I hear a lot of the other side of the coin. So basically, you're looking for volatility to increase and the asset bubbles to pop. And during these times, Peter, what I'm more concerned about than a bad economy or what's happening in Washington is all the hot spots around the globe. Do you think that's also part of it, that we could have some type of conflagration anywhere? Is that in your telescope?
So
yeah,
I do expect a couple of things. I think folks have missed the association between oil prices and ISIS terrorism, for example. We've seen oil in the last couple of years double in value, and you'll notice that we're now suggesting that ISIS has been vanquished. One of the things I noticed in the past is that as oil prices fall, we tend to see much higher levels of terrorism, and that is something that I think we just need to put on our radar screen as a potential consequence of declining energy prices.
Well, how about the relationship between Saudi Arabia, Israel, and the U.S. and decertification of the Iran deal? Do you think something could happen there? I've interviewed people who think something could.
Yeah, that's not an area that I'm especially knowledgeable about, so I'm hesitant to provide insight there.
Okay, how about one more area? The Chinese have been stockpiling wheat dramatically over the past few years. You brought up the Old Testament. Joseph was the best commodity trader in the Old Testament, and he planned for, he had 7 years of plenty, 7 years of naught. Do you look at anything agriculturally? We have a La Nina year happening here in the Pacific, and as a commodity trader, that has led to poor growing conditions in the Midwest. You see anything happening in the agricultural markets?
I do. I think that wheat has been one of those. A couple of weeks ago, I commented that a logical pairs trade to me in terms of sentiment would be short oil, long wheat. I couldn't come up with a catchy tagline for that, but clearly energy costs look like they're going to come down at the same time food costs may rise.
Okay. Thank you so much for your time, Peter. I hope you enjoyed your time here. I found it fascinating, and I'm so glad I reached out to you on Twitter. I appreciate your time today.
I really appreciate the opportunity, Dale. Thank you so much.
Yeah, we all enjoyed it. Thank you so much, Peter. Good hunting, and let's get back together, say in about 3-6 months, and see how things are unfolding. Okay?
That sounds great.
All right, everyone. That was Peter Atwater. You could follow him on Twitter at Peter_Atwater, and there you see his website, Financial Insights, spelled with a Y, not an I. Thank you, everyone, and we'll see you tomorrow for Turnaround Tuesday. Good hunting, and above all, don't just count your pips, count your blessings. See everyone tomorrow. Thanks again, Peter.
Thank you, Dale.